Nifty 50 has reached an all-time high of 21,000 points, and a lot of Indian investors are feeling scared that the market is perhaps overvalued and they should pull their money out of the Indian stock market. But in this video, I will tell you why you should never bet against the Indian stock market and continue to stay in the market for the long term. I will talk about some key macroeconomic data points that will suggest why the Indian stock market is still not at its full potential and why it is still the best place for Indian investors to create long-term wealth for their future. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running, and if you find this video helpful, then show your support by liking and subscribing to the channel. Before I begin talking about the macroeconomic data points, let me start by sharing a valuable lesson from famous American investor Peter Lynch.
So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. It's always going to be scary. There's going to be always something to worry about, and you just have to forget all about it, cut it all out, and own good companies or own turnarounds. Study them and you'll do well.
And this lesson was shared almost 50 years ago, but it still holds true today. Over the last 2 decades, India has been among the fastest growing major economies in the world. But despite this high growth rate, the per capita income, when adjusted for purchasing power parity, is only $7,000. Whereas the per capita income for other large countries such as United States is $70,000 and for China it is $19,000. What this data suggests is that an average Indian citizen produces and consumes almost 10 times less than an average American citizen and almost 2.5 times less than an average Chinese citizen. While this may sound like a sad fact, but the silver lining is that there is a massive opportunity for growth in the Indian economy. If every Indian citizen produces and consumes at the current level of an average American citizen, the Indian GDP can easily multiply 10 times from $3.5 trillion today to $35 trillion over the next 2 to 3 decades. The next important metric to look at is the number of people investing in the stock market. As of 2024, only 3% of Indian households invest in the stock market. But when we compare this to China, the retail participation is 13%, whereas that in the United States is 55%. Even though the percentage of population investing is low in India, it has seen a massive growth over the last 3 years after the COVID-19 pandemic. India has added 15 to 20 million or roughly 1.5 to 2 crore new demat accounts every year since 2020. And as of 2024, the total number of demat accounts in India is roughly about 13 crores or 130 million. India has the 4th largest stock market with a total market capitalization of $4 trillion, which is still far behind the USA, which is at $45 trillion, and China, which is at $10 trillion. But as more people open demat accounts and start investing in the stock market, the Indian stock market will rise in ranking over the coming decades. Now let's talk about the next most important macroeconomic factor that will boost India's economy over the coming decade. The economy of a country is nothing but the number of people multiplied by the productivity per person. So the economy rises when either the number of people increase or the productivity per person increases or both. India now has the world's largest population ahead of China. Not only does India has the largest population, but also the youngest among all major economies. The average age of Indian population is around 28 years, whereas all other major economies such as China, USA, UK, Germany, Japan, and so on, all have population aged 40 years or older. This means that there will be a huge influx of working age people into the labor force in India, which is and will continue to make the Indian economy grow at one of the highest rates globally over the next decade or two. The next biggest macroeconomic trend in India, which will lead to the unleashing of India's potential, is the acceptance and promotion of privatization, increased foreign trade, and improvement in ease of doing business. Here are 4 key structural changes that will make India a better place to invest and to do business. Firstly, the introduction of GST or Goods and Services Tax Reform has brought in more businesses under the tax rules, which has reduced the size of black economy, brought more businesses under tax rules, and increased the government's tax revenues. Secondly, the Indian government has led a massive privatization drive and sold off nearly $20 billion worth of loss-making and inefficient public companies in the last 3 years. And the government plans to sell another $50 to $60 billion worth of inefficient public assets over the coming years. Thirdly, the government has opened up more sectors for foreign investment, and the foreign direct investment into the country is consistently rising from about $30 billion annually about a decade ago to over $50 billion annually today. The fourth and final factor is the rise of technology-driven entrepreneurial youth of India. India has the 4th largest technology startup ecosystem in the world, and as more and more youth work in the field of technology, the per capita productivity of the nation will shoot up massively. So, as India's most successful investor Rakesh Jhunjhunwala says, the mother of all bull market lies ahead of us. So, if you are an Indian investor, then do not bet against the Indian stock market and invest for long term in a very well diversified portfolio for the coming decades. If you find this video helpful, then show your support by liking and subscribing to the channel.